Now, for the calculation of depreciation, let's refer the concept of block of asset along with the applicable rate of depreciation for every block, defined under section 2 clause 11. Okay, so we have building and furniture and fittings, and then plant and machinery, intangible assets. Okay, to consider this being a same block, 2 points could be verified. One is same kind of asset, okay, and the applicable rate of depreciation should also be the same rate of depreciation. These two should be verified and confirmed that it falls in the same block or not. Same rate of depreciation. Clear? So predominantly we have four asset blocks. Within each and every asset block, we have different rates also. Especially when it is all about building, we have three different rates. So number one being residential building. Number two being official, office, factory, admin, this building, factory. Okay, go down and etc. The last one being temporary structures. Okay. Temporary wooden structures. Actually, if the building is used for residential purpose, residential means let out for the quarters, like, okay, to the employees and all, not for the occupied property. That you have studied the income from house property, right? In income from house property, residential house property you have for self-occupancy as well as let out. Can I claim the depreciation on that? No. If the property is used for the business purpose, then you can claim. In income from house property, we studied the let out of any business premises for supportive entities like some police stations and excise department, government department, banks, to render good support for their employees, for the organization. They may let out. So the intention is not to let out to earn money, to let out to support their own business. So the letting out to these entity, banks and police station as excise department, or for business purpose, so falls under PGBP. If they are using this for the residential purpose, then claimable depreciation can be claimable under this section at the rate of 5%. This will be 5%. And office, admin, factory, 10%. Temporary wooden structure. If you plan to construct a mall or building for temporary purpose, for accommodating the materials, they will have a small hut. They will keep all the materials in that. Once the building is over, that hut may be demolished. Some temporary structure may also be constructed for that applicable rate of depreciation being 40%. So from this it is very clear, within building we have three blocks. Building meant for the residential purpose carries 5% depreciation. If you are purchasing further building also falling in the same block, you will be grouped. Similarly, office, administration and factory related building will be grouped. If we are not going to calculate the depreciation for each and every asset independently, we will be grouping and calculating the depreciation in single shot. And a temporary structure. In case of furniture and fittings, the rate of depreciation is very simple. Okay, 5%. 10%. It will be for 10%. Clear? And in case of intangible assets, of course, you can claim 25%. Usually, intangible assets falls may consist of know-how, patent, copyright, trademarks, license, franchise, and etc. Provided, okay, goodwill cannot be taken. Goodwill cannot be taken. Leaving the goodwill, all other assets, intangible assets will be depreciated at the rate of 25%, where you might have paid the money for this. Technical know-how, some brand image, for that you may pay money and purchase it, or you may develop by incurring some costs. Those costs may be capitalized and amortized over the years at the rate of 25% WDV method. This will be depreciated at what method? WDV method only. WDV method only. In case of plant and machinery, let's see. We have block 1, block 1, block 2, block 3, and block 4. We have almost 4 blocks in plant and machinery. So from this it is very clear, 3, 1, 4, 1. How many overall blocks we have? 9 blocks we have. All the assets for a company can be grouped within the 9 blocks. Okay, you may have hundreds of different assets. Everything can be grouped into 9 blocks. You can calculate the depreciation for these 9 blocks only. That's all. Very simple. Calculating each and every assets and depreciation on it may be time consuming, but of course we no need to do that. So you can group all the assets into the 9 blocks. Maximum, most of the cases, only 2 or 3 blocks only available for the companies. Only for the 2 or 3, you can straight away calculate in simple sense and claim the depreciation as your deductions from the PGBP income. Okay, as per section 32. And this will be always at what rate? Means this will be always at the WDV method only. You cannot use the SLM method here. Now, second being ships. Third being motor vehicles. Fourth being aeroplanes. Aeroplanes. So you can very easily remember 3 mode of transports. 3 mode of transport: ships, motor vehicle, aeroplanes. Ships are depreciated at the rate of 20%, and motor vehicles depreciated at the rate of 30%. Aeroplanes depreciated at the rate of 40%. Very simple, right? You can understand this very easily. 3 modes of transports. 3 modes of transports. Clear? 3 modes of transports. Now, ship, motor vehicle, aeroplanes, waterway and roadways as well as railways. 3. 20, 30, 40. It's very simple. Not only that, along with these 3 assets, we have some other assets also following the same block. Like in case of motor vehicle, provided the motor vehicle is used for hire purchase. Sorry, hire purpose. Sorry. Okay, for hire. Then you can claim at this rate. Ships includes vessels, speedboat, and everything. In case of aeroplanes, it includes engines also, aero engines. Okay. Apart from that, we have a list of other assets also following the block number 4. What are they? Computers, laptop, computer softwares, laptop and softwares, including UPS, printers, scanner, everything will fall under this case. Books, gas cylinders will fall under this case. Okay. Life saving medical equipment, medical equipment. Energy saving, life saving, now energy saving. equipments. Okay, equipments. Apart from that, two more items also there. Okay, three more items. One is windmill, another one is equipment, pollution control equipment. Another one is water supply projects, water supply. Provided in case of windmill, installed on or after 1/4/2014. So, second block in plant and machinery is related to the ship and vessels, speedboats. For all these things, the rate of depreciation is 20%. Motor vehicle, it's not for the business own vehicle, may be used for the for hire purpose, rental purpose of the vehicle. You can carry the depreciation at the rate of, it will carry the depreciation at the rate of 30%. And aeroplanes, aero engines, 40%. Along with that, computers. Usually, computers will be depreciated faster because of the obsolescence loss. Laptop and the softwares and UPS, printers, scanners, and everything will fall into the same. Books, life saving and energy savings equipment. So this is very simple. Okay, life saving is most important. Power consumption is also be reduced. For that, they will install some energy saving equipment. Government motivates, so 40% depreciation is there. As far as water treatment, any water contamination is there, you treat and reuse it, then the government is happy, so 40%. And pollution, so make the pollution free nation. So the government offers 40%. Say higher the depreciation, more is the benefit to the investors, because the business people debit higher value in the P&L account, reduces their profit, showing the lesser profit may be good for the owners. They will pay lesser tax. In case of windmill, that too 1/4/2014, because energy is also matter here. So for all these things, government is intended to give 40% depreciation. Earlier, we had 60%, 80%, 100% also be depreciated. But now there is a cap. Not beyond 40% can be eligible for depreciation. Is that okay? Only 40%. Aeroplanes, aero engines, computers, laptops, softwares, books, gas cylinders, life saving, energy savings, pollution, and water treatment plants. Windmill installed after 1/4/2014 will fall in this case. Now, what about the first point, sir? Those items not falling under the other blocks of the plant and machinery, you can claim the depreciation at the rate of 15%. The previous class also I told you, if nothing is stated, you can take 15%. That's a default. That's a default. Usually, these are the default. Okay, 10%, 10%, 15%, and 25% is the default. Okay, unless specifically stated, if the building information is given, you can take 10%. Furniture 10%, plant and machinery 15%, intangible assets 25%. If they are specific with some asset, then of course you have to guess. If you are not able to guess, no need to worry about that. The rate may be usually given in the question paper itself. No need to worry about that, right? And the 15%. Okay, all other plant and machinery not falling under this. Okay, not covered, not covered under other blocks, other blocks. And plant and machinery excludes what? Okay, so tea bushes, tea bushes, tea bushes, and livestock, livestock, building and furniture. Okay, already we studied the building falls under other, so these two will not come under plant and machinery. Tea bushes as well as livestock. Tea bushes, right? Tea leaves. You might have seen the tea plantations in Munnar and Ooty. So beautifully, the nature you can enjoy. That plantations, right? So when I had a chat with the workers in the tea estate, I asked them when this was planted. They simply told it was around 150 or 200 years ago, not currently. 150 or 200 years ago. Okay, it's very hectic job. Earlier, almost 100 years ago, 150 years ago, British period, they want to have the tea. So they brought the tea leaves from other country and planted here, and the estate was created. Okay. So the plants, no, They simply cut the leaves. Okay, the first young leaf will be for high class tea. Usually we don't like. The taste is very bland and not interesting. Okay, and second leaf, third leaf. That's how the leaves may be taken and the grade is decided. Right. That tea leaves, the bushes, it's very tough to regenerate. Once landslide happens, the entire tea leaves and bushes may go off. For those things, rebuilding will be huge cost. So government always gives huge discount for the tea companies, okay, tea estate companies, because losing the tea bushes will be a big loss for them, right? So they offer around 40% deductions from their profit. We'll study that along with section 33 A, B and AB. So there we will be studying, okay, AB and ABA. So those sections we will be referring. So because of that reason, tea bushes will not fall under plant and machinery. You cannot claim the depreciation separately for the tea bushes. Clear? Apart from that, motor vehicle. Sir, already you told me that vehicle falls under this category, sir. Yes, this is far higher. So this is not far higher, not far higher. Okay, not far higher. And windmill we have seen. If windmill installed on or after 1/4/2014, you can eligible for, you can deduct almost 40% as depreciation. If it is installed before that date, of course, the rate may be only 15%. Windmill not covered under other head. Okay, 1/4/2014 before 15%. Now, oil wells, and EPAPEX, intercom. Okay, intercom is otherwise EPAPEX, named as EPAPEX in short, and mobile phone. EPAPEX, electronic private automatic branch exchange, was the expansion for this. Of course, not required for your understanding or requirement for the examination. At least to know the expansion you can have for the additional learning. Electronic private automatic branch exchange. That's what about the expansion for this in simple intercom. Apart from that, mobile phones. All these things carries depreciation at the rate of 15%. Clear? So in building we have three blocks: residential 5%, and in case of commercial use, it may be worn out faster, so 10%. In case of temporary structure, it will not have life more than few years, 2 or 3 years, and sometimes it may be lost within 1 year also. Then you can claim 40% depreciation. So what happens if it is lost within 1 year or 8 months after the depreciation of 40%? Sell it off. If there is any profit or loss on sale of that asset, can be claimable as a short-term capital gain or loss under section 50. We will see that later on. Is that okay? In case of furniture and fittings, 10% rate will be applicable. Plant and machinery, we have 4 blocks. Second, third, fourth, very easily you can remember 3 modes of transports. One is all about ship. Second one is a motor vehicle for hire. Third one is aeroplanes and engine. 20, 30, 40%. 20, 30, 40%. 40% is applicable not only for aeroplanes. Government intends to promote some of the expenses to be incurred, like energy saving devices, pollution control equipments, and water treatment. So all these things. Apart from that, windmill installed on or after. This is also requirement for the energy generation only, right? So was introduced from 1/4/2014, higher rate depreciation claimable for the windmill. Apart from that, computers and books, gas cylinders. That's how you can easily keep that idea in your memory. Those things not falling under these heads will fall under the general class, where 15% rate of depreciation will be eligible. In case of motor vehicle, especially acquired and put to use between this period, 23/8/2018 to 31/3/2020. If you purchase and implement, use this within this period, the rate of depreciation in this case be 45%. 1.5% excess. The same here, between 23/8/2018 and 31/3/2020. The rate of depreciation should be 30%, double times you can claim. was introduced as per the requirement of the industry. The industry people says we don't have the sales that give some suggestion or concession. So then immediately government gives an announcement: if you purchase lots of vehicle, car, you can claim 30% depreciation and 45% depreciation. If you are able to claim 45% depreciation in the very first year for 10 lakhs rupees of car, 4.5 lakhs can be debited. So if you are having the income of 5 lakhs, you debit that 4 lakhs 50,000 rupees, your income is drastically reduces to 50,000. In order to motivate to claim more depreciation, pay lesser tax, government gives higher depreciation for the period whenever it is in need. This was the period where the sale is very lesser, and as per the requisition, the government gave more depreciation, so that there will be pump in the sales also during the period. So these are the 9 blocks you can better understand. If you go and refer the original section 211, 2 class 11, n number of list is there, but of course not required to memorize all these things. You just have the idea. The ideas I have given, that's more than enough, right? See here, section 2 class 11, block of assets: a group of assets with same class and the same rate of depreciation. If these two are there, then it will be considered as a block. How many blocks are there? In building we have 3 blocks: 5%, 10%, 40%. In furniture fittings, 10%. In case of plant and machinery, we have 4 blocks. One is 15%, next 20, 30 and 40, and the last one being 25% intangible assets: know-how, patent, copyright, trademarks, licenses, franchises, any other business or commercial rights carries at the rate of 25% depreciation under SLM method, sorry, WDV method. Not being goodwill, you cannot claim the depreciation for the goodwill. Is that clear? In case of ships, you can claim 20. In case of motor vehicles, and that too used for the hire purchase, 30%. Aeroplanes, aero engines for 40%. Apart from that, computers, book, life saving, medical equipment, energy saving, pollution control, water supply projects and water treatment. Apart from that, windmill installed on or after this period, claimable at the rate of 40%. Those assets not falling under the any other block will come under plant and machinery, where tea bushes, livestock, building and furniture will not fall under this. Apart from that, in general class, motor vehicle other than those used in the business of running them and hire, not being the hired for hired business motor vehicle, you can claim the depreciation at the rate of 15%. Windmill installed before this date, oil wells, e-papex and mobile phones, means intercom and mobile phones. These things are carrying at the rate of 15%. Slight updation was there, which is nothing but between these two period, if any motor vehicle is purchased not for hire, then 30% will be claimable. In this case, rather than 30, 45% can be claimable. Hope you will be now able to understand the calculations and finding the blocks here. Clear? Now, section 32 class 1 subclass 1, we'll study this separately because it's nothing but SLM method of depreciation. Now our focus is all about what? Second one, depreciation on WDV method, where the WDV method is adapted on block of assets, not individual assets. These 2 points are going to be covered in detail. And who is able to claim the depreciation? Only owner. That too, beneficial owner is the matter. Registered owner is not being the person of rights to claim the depreciation here. And if the owner is not full complete owner, only part of the owner, then to that part he can claim the depreciation. To that part he can claim the depreciation. Assets should be used for his business or professions. Assets should be used for his business or professions. That we have discussed all these points in the previous class. Hope now you'll be able to understand all these things. So how can we calculate? Number 1 being opening WDV of the block. With that, add purchases of any assets falling under the block. From that, you can subtract the sale of any assets in that block. Okay, number of assets and value of the block of assets. Okay, finally, after adding purchases, subtracting the sales, whatever the value you get, you know. Okay, this will be positive, as well as this one also be positive. Then you can claim the depreciation. If these two being the positive, then you can claim the depreciation. So while calculating the depreciation, understand that in the purchases, number 1 being purchases where Okay, put to use is less than 180 days, then half depreciation will be claimable. If put to use is 0, okay, not at all used, okay, not at all used, then no depreciation. Okay, and put balance value if any. This balance we are going to categorize this way: put to use less than 180, put to use not at all used at all, and balance value. For the balance value, you have no, for that full year depreciation can be claimable. Okay, depreciation. Now, if you subtract this, then the ultimate value will be closing WDV. Closing WDV. Whatever the asset you purchase, you have three categories of that purchased assets: purchased and put to use less than 180, purchased and not at all used, purchased and used at or more than 180 days. So these are the three blocks we have. Now this one being minus, this one being minus, this one being minus. So in case of minus, what happens, sale consideration will be taken. From there you have to subtract opening WDV plus any other assets purchased. Okay, so from the sales you have to subtract this two. From this you have to subtract this one to get the what? Capital gain. The capital gain what you get here is called short term capital gain or loss as per section 50. So when I teach the capital gain chapter, this component I don't teach because it's over here itself. It is over here itself. Is that clear? Hope you'll be now able to understand. Now, this sum is an imaginary illustration. Find out block of assets and calculate the depreciation if it is possible. Else, you have to calculate short-term capital gain or loss. Also, you have to calculate closing WDV of the block. Okay, let's start here. Now, this is what about the opening WDV value given. We'll start with this. 1424, we have been given plant and machinery, two numbers, rate of depreciation applicable being 20%, value being 1,50,000. So block number 1, plant and machinery, applicable rate of depreciation in this case being 20%. This is what about the block number 1. Is that clear? Opening WD of this block, two numbers we have, the value being 1,50,000. So this is block number 1. Second one being plant and machinery, rate of depreciation applicable for this being 30%. So plant and machinery, applicable rate of depreciation being 30%. As this one has different rate of depreciation, we have to calculate separately. In this block, opening WDV being 40,000 rupees and number of asset is missing, maybe assumed to be only 1. Another one also be plant and machinery, we have only one number, applicable rate of depreciation being 15%. So this particular one will not fall under any other plant and machinery because the earlier two plant and machineries are having totally different depreciation. One is 20, another one is 30. Now this plant and machinery has the depreciation rate at the rate of 15%. So plant and machinery 15% rate will be taken here. Now opening WDV, opening WDV. How many assets we have? Only one asset we have, the value being 20,000 rupees. And the another block is all about building. It's a totally different kind of asset, and rate of depreciation for that is 10%. So I need to open one more block here. Building, applicable rate of depreciation being 10%. And opening WDV of this block being 20,000 rupees. 20,000 rupees. Then furniture. Furniture 10% block. Usually furniture, all the furniture falls under 10% only. In case of furniture, we have only one asset block. So opening WDV, how many assets we have? Two numbers and 30,000 rupees. One of them purchased on 1723 and put to use only on the last date. In this, one asset purchase date being 1723 and put to use being 31/3/25. Is that clear? So we have identified 5 blocks here. Plant and machinery 20% block, plant and machinery 30% block, plant and machinery 15% block, building 10% as well as furniture 10% block. In furniture 10% block, we have two assets in the beginning. Among the two, between the two, one was purchased in 1723, not the previous year, prior to the previous year. So previous year being 14/24 ends on 31st March 25. Actually, the asset purchased in the prior to the previous year. In this period, it was purchased that too on 1723. And this asset was put to use on the last date. Usually, the put to use is less than 180 days, carries only 50% depreciation, provided if the asset purchased in the previous year. If the asset purchased prior to the previous year, not used in the previous year, no eligibility for depreciation in the previous year, but it was whether used or not, or less than 180 days or not, you can claim 100% depreciation in this current previous year. Is that clear? Already I told you here in the notes for the calculation of depreciation. Is that okay? This point. Purchased in the prior to the previous year, not at all used in the prior to the previous year. In the current year, you may use or not use, or the use may be very less than 180 days. Though it may be less than 180 days or more than 180 days or not at all used yet, you can claim 100% depreciation. If the asset purchased in the previous year and used to less than 180 days, then it will carry only 50%. Purchased in the previous year, not at all used in the previous year, zero depreciation will be eligible. Is that clear? Hope now we'll be able to understand all these logics. So this will not be a matter for me. You can simply score out. This is an additional information like to confuse you, as the asset was purchased prior to the previous year, then put to use is not a matter. This asset is eligible for 100% depreciation. Right. Now, this is nothing but opening WDV as on 1/4/24. As on 1/4/24. And purchases during the year. During the year purchases. So purchases will be now identified to include which of the blocks and then include for the calculation of depreciation. Right. Let's see. Plant and machinery purchased 20,000 rupees. And the rate of depreciation applicable for this being 20%. Then it falls under which block? First block, plant and machinery here. So add purchases and one asset purchased for rupees 20. Actually purchased on 1/7, ready to use on 25/8/24, but not used throughout the year. Readily available for use but not used. Readily available to use is nothing but passive use. Passive use is eligible for claiming the depreciation. You don't need to worry about that. So you can claim the depreciation for this completely. Clear? So this is not a concern for you. Ready to use is called as passive use. You can claim the depreciation. So use represents active use as well as passive use. Passive use is nothing but the state of ready to use. That is standby asset. This one also be eligible for full year depreciation. Okay. Now 10/7/24, another building purchased for rupees 1 lakh. Building. We have this fourth block. Add purchases of a new building on purchase date being 10/7. We assume the purchase date is equal to the put to use. So 180 days more than 180 days. So eligible for full year's depreciation. Furniture. Next one being furniture. Furniture falls under the fifth block. Fifth block. Okay. Add purchases. One asset purchased for rupees 10,000. Purchased on 15/7. From the date of purchase, it is more than 180 days. But put to use in the last date. Even if you are using 1 day, eligible for 50% depreciation. Is that okay? Because less than 180 days. It doesn't matter, 1 day or 2 days also be eligible for depreciation. So I give a small hint representing this one is eligible for half year's depreciation. Is that okay? Another one being plant and machinery. Another one being plant and machinery. So still we have 3 more items. So we have plant and machinery purchased on this date 30%. This falls under which block? Second block. So in the second block, I am going to add the purchases. 1 lakh. Now tell me. Purchase date being 5/11. Definitely the put to use should also be less than 180 days. So half year's depreciation only eligible for this. Another plant and machinery 40%. Come on, tell me which block it will be included. So we don't have any block corresponding this block's asset. So we have to open a new one. Plant and machinery 40%. Plant and machinery 40% is the new block. We don't have opening WDV, only the purchases. Purchases being 1 lakh. And purchased on 14/1 January. Definitely put to use is less than 180 days. So half year's depreciation is eligible. Half year's depreciation is eligible. Then furniture. Already we have furniture. So here one more purchases is also there. The value being 5,000. When it was purchased, 1st February. 1st February means less than 180 days. So we have completed adding the purchases by identifying the block where it can be included and included that. So after identifying, we included in that concerned block. Clear? Now, sales during the year. Sales during the year. Now tell me. Plant and machinery 20% rate of depreciation falls under which block? The first one. From here I am going to subtract the sale value. Value being 40,000 rupees. One asset sold for 40,000. So at the time of sale, the year of usage is not a matter. At the time of purchase only, year of the days will be calculated for the eligibility of full year's depreciation or half year's depreciation or no depreciation. Clear? At the time of sale, in the year of sale, the asset may be used for even single day, eligible for full year's depreciation. Full year's depreciation. And building. Already we have the fourth block, so I had to subtract here. So minus sales. The value being 4 lakhs. Plant and machinery 30% block. Second block. It will fall under second block. Okay. Minus sale. Minus sale. What is the value? 60,000 rupees. And 1-3, another plant and machinery falling under 40% sold for 1,20,000. Okay, where it is? Okay, the last block. So minus sale, 1,20,000 rupees. Nothing stated. Earlier we have one asset. Now also sold one asset. 25,325. Another plant and machinery sold, which is having 15% rate of depreciation. So 15% falls under which block? Third block. So here there is no purchases, only sales. Okay, 10,000. 10,000 only, no? 10,000. Sale value being 10,000. So very easily you can identify the blocks of assets. 9 maximum possible blocks are there, and based on the kind of asset and kind of same rate of depreciation, then we can group that as a single block. And any purchases falling in the same block in the year of accounting, means previous year, you can add with that. While adding the assets newly purchased in that same block, we always cross refer whether it is used more than 180 days or 180 days or less than 180 days or not at all used. That will play a vital role in calculating the depreciation for full year or half year or no depreciation. And find out any sale in that same block, then it can be subtracted. Now finish up this one here. First of all, 2 plus 1, 3 minus 1, 3 assets we have. Here the value being 150 plus 20, 170 minus 40, 130. 130. Is that clear? Clear? Now, value is also there, asset is also there. Value is also there, asset is also there. Then what you can do? You can calculate the depreciation. At what rate? 20%. Is there any asset purchased and put to use less than 180 days or no use? No, such information is missing. Means all the assets used for more than 180 days or 180 days. So eligible for full year's depreciation for this. So the value being 26,000. So the closing WDV being 1,04,000. How many assets we have? Still we have 3 assets. This will be opening WDV for the next year. Huh? Okay, 2 assets. Okay, 2 assets. Right. And here plant and machinery plus 30% rate of depreciation. 1 plus 1, 2 minus 1. We have 1 asset. 40 plus 1 lakh. 1 lakh 40 minus 60, 80,000 rupees. So asset also exists, value is also positive, we can claim the depreciation. While claiming the depreciation, find out whether any asset purchased and put to use less than 180 days. Yes sir, this asset purchased and put to use is less than 180 days. Value to the extent of newly purchased item will be carrying 50% depreciation. Balance, if any, will be eligible for full year's depreciation. But here the value is 80, but the newly purchased items value is 1 lakh. Then the entire closing value 80,000 is eligible for half year's depreciation to the extent of newly purchased assets value. Okay, so this 60,000 rupees, 80,000 rupees, sorry, 80,000 rupees depreciation can be claimable at the rate of 30%, but only for half year. You can ask me, sir, why not the newly purchased is 1 lakh? No, for the entire 1 lakh you can calculate half year depreciation. No, sir, that 1 lakh is the newly purchased value of the asset, but the closing value is less than the newly purchased assets value, means the entire closing value is eligible for half year's depreciation only. Half year's depreciation only. Then 12,000 rupees, am I right? So if I subtract the 12,000 rupees from 80, still we have 1 asset, the value being 68,000 closing WDV. Clear? Now, building case, this case. We have one existing asset, sold that existing asset. Now we don't have the asset, but value is there. As we don't have the asset, we cannot claim what? Depreciation. No assets in that block. Simply showing 10,000 rupees in the balance sheet as a value of the asset without showing the asset is not logically correct. So hereafter it's not asset. Hereafter you should not have any balance for the block. Now what does it mean? You sold for 10,000 rupees. Actually the worth in your books is 20. You are selling less than its worth. Then definitely it's a loss. So loss will be named as short-term capital gain under section 50 as per the income tax purpose. Usually in your P&L account, what do you do? The WD value of the assets being 20, sold for 10. Then naturally you say the loss on sale of the assets. The loss on sale of assets in capital gains in taxation will be named as capital gains, that too short term. Short term. This will be always named as short term. Okay. Clear? So as this one is negative, sale consideration being 10,000 rupees minus opening WDV of the block plus if any purchases. Opening WDV of the block being 20, we don't have any purchases in that block, so 20,000 is the worth. The worth of the block is 20, but all the block assets sold for only 10,000, we don't have any more assets. So we realized the less than the value we show in our book, then that lesser value, lower value will be considered as your loss, named as short-term capital loss here. Okay. If I show the value in brackets, maybe loss. Maybe loss. Similarly, in case of building, opening WDV, we have one asset, newly purchased asset 1, sale being 1, so still we have one asset. But the value becomes 2,80,000 negative. So in your book, the value of the asset being 1,20,000, opening plus newly purchased asset both put together, the value of the block of assets being 1,20,000, but sold for 4 lakhs. Value is there, but asset is there, but value is missing. So as value is missing, you cannot show negative value in your balance sheet, right? So 1 lakh rupees is the value of the asset, sold for 1,50,000. From 1 lakh subtracting 1,50,000, showing 50 negative in balance sheet is illogical. It means whatever the book value you sold, beyond that you recovered some gain, profit on sale. The profit on sale, usually we call this being, you can consider this being profit on sale in your financial account, will be named as capital gain here, right? So sale consideration being 4 lakhs minus opening WDV and purchases in that year. Overall book value of the block of assets before depreciation 120, but entire block of assets sold for 4 lakhs, recovering more than its book value by 2,80,000. Excess recovery is called short-term capital gain or loss, but here it's gain under section 50. Under section 50. Clear? Now, in case of furniture, we have already another two purchased, so 4 furnitures are there, the value being 45,000. 45,000. Value is also there, asset also exists. Then what do you have to do? You can claim the depreciation. So minus depreciation. While calculating the depreciation, okay, is there any sales in the furniture? No, only purchases. Now, so for the newly purchased asset, put to use less than 180 days. What are they? These two. For these two, you can claim the depreciation at the rate of 10% for half year, 750. For the balance, balance being 30,000. For that, you can claim full year's depreciation, 3,000. Overall eligible depreciation in this case being 3,750 can be subtracted from 45. The ultimate closing WDV being 41,250. Closing WDV. Clear? Next, here already we have one asset purchased and sold missing, and asset also missing. We don't have the asset, we don't have the value. We need to have the assets and the value to calculate the depreciation. If one of these two are both not available, then you can calculate the short-term capital gain or loss. In case of short-term capital gain or loss, sale consideration of the block being 1,20,000 minus purchases being 1,00,000. The difference between these two, 20,000, is short-term capital gain or loss. Here, gain. So this particular illustration gives you a complete idea about the depreciation. Clear? Yes, come on. Make a note of it. If it is clear, text me so that we move on to the next illustration. C. Depreciation under section 32 clause 1 2 mentions how to calculate the depreciation on WDV, where the depreciation will be calculated based on the block of assets value. Right. And the depreciation is the balance sheet, previous year 24-25. You have car for hire business, 20 lakhs. In P&L account, how much you can claim? Car for hire purchase, purpose. 30% rate of depreciation is eligible, right? For 20 lakhs, 30% is being 6 lakhs can be claimable. 6 lakhs can be claimable. Clear? Sir, can I leave unclaimed, sir? I don't want to debit this in your P&L account. I am happy to pay more tax. So, my net profit being, or my net profit before depreciation being around 30 lakhs. I can enjoy claiming the depreciation 6 lakhs and the taxable net profit being 24 lakhs. Can I say, sir, I don't want this depreciation, I can consider the PBT being 30 lakhs and I can pay the tax on this? Is it possible? Can I skip debiting the depreciation in our P&L account? No, you cannot do so. You have to claim the depreciation by debiting to the P&L account. It's a mandatory claim. You may be surprised, why, sir? If I don't debit the depreciation in the P&L account, profit will be higher. For that, if I calculate the 30% depreciation, higher tax I am paying to the government, so government should be happy only. No. Why do I mandatorily claim the depreciation? because government is double cautious. If net profit being 30 lakhs, if the net profit being only 1 lakh, or you have net loss 1 lakh, you have net loss. If you debit the depreciation, what happens? Your net loss increases to 7 lakhs. Okay. If you don't debit the depreciation, your scenario being only 1 lakh, no tax. By debiting also, your loss is increasing to 7 lakhs, no tax. Next year, in the previous year, 25-26, where his net profit is 30 lakhs. Now he says, sir, last year I didn't claim the 6 lakhs depreciation. This year also another 6 lakhs or 4 lakhs under WDV method. Can I claim overall depreciation 10 lakhs in this year, sir? Such a cheating may be possible. In order to avoid whether you have the option to debit in your P&L account or not, whether you have the profit or not, you have to mandatorily debit to the P&L account. You have to mandatorily debit to P&L account. There may be chances. You may play, if I want to show lesser tax, claim depreciation. This year I want to show lesser tax. Okay, 3-4 years I forgot to debit the depreciation. I can debit everything today itself. Okay, if you want to increase my profit this year, I can don't show the depreciation in the P&L account. Such a manipulation is prohibited. That's why depreciation is a mandatory claim. Understand? Okay, so if it is not so, this is similar to what? You may write the examination and score 130 marks out of 200 marks. And now you request the board, share this 130 for 2 papers at 65, make me exemption in these 2 papers. Similar logic will happen. So give me the mark here. Give me the mark here. So such a way, you may have the chance to cheating. That's why mandatorily you have to claim. Mandatorily. Whether you have a sufficient profit or not, the depreciation should always be debited. Point number 1. Right. Apart from that, under depreciation, section 32, we have 2 models of depreciation. One is SLM method, another one is WDV method. Okay. This SLM method will be applicable for whom? Power generation as well as power generation and distribution. Optional. Sir, can they claim under the same model, sir? Yes, sir. They can claim depreciation under the WDV model also. It's their choice. So, for the power generation company or power generating and later on distributing to the consumers, I am doing these 2 activities. Can I claim the depreciation on my assets under SLM method? Yes. Can I go for WDV method? Yes, of course you can go here or there. It's your choice. For all other companies, they have to choose only WDV method. Only WDV method for others. If WDV method is chosen, you have one more benefit to claim additional depreciation. Additional depreciation. This will be under section 32, class 1, subclass 2. This will be section 32, class 1, subclass 2A, related to that. If you claim the depreciation under WDV method, though you have the option to go for SLM method in case of power generation and distribution company, yet you opted WDV method, only then you can claim the additional depreciation. If you are being the power generation company, if you choose this, of course, additional depreciation cannot be claimable. Additional depreciation cannot be claimable. Additional depreciation can be claimable only once in a year, only once in a purchase time. You can claim 20% in the very first year. So if you purchase an asset for 1,000 rupees, it's a new block. Normal rate of depreciation for this block is 15%. So minus depreciation, 15% being 150. under what? Section 32, class 1, subclass 2. Apart from that, you can claim another 20% on this value under section 32, class 1, subclass 2A. This is 20%, it's 200. So, very first year, you can claim 350 rupees depreciation. 15% is the default if it is being the default plant and machinery. After claiming, you can further claim another 20% on this. Suppose the asset is used for half year. The asset is used for less than 180 days. What happens then? 15%, right? So 15% on 1000 being 150. In that 150, you can claim only 50%. How much? 75. As the put to use is less than 180 days, you can claim only for half of the year's depreciation. What about that additional depreciation, sir? Rather than 20, you have to claim only percentage, sir. That another 10% can be claimable in the next year. So the 20% is a lifetime once for an asset newly purchased. Year after year can be claimed? No, sir. You can claim only 20 in this year. Next year, what happens in the case of next year? In the next year, the WDV value being 650. Here for the next year, you can claim the depreciation under section 32, class 1, subclass 2 at the rate of 15% on this. How much is that? 15%. 97.5. What about the additional depreciation, sir? No, you cannot claim the additional depreciation. So the ultimate closing WDV for the next year being 552.5. 552.5. Am I right? So what happens in case of half year's depreciation, sir? 1000 minus 175, 825. Now you can claim the depreciation at the rate of 15% on this 825. Come on. 123 point. But don't forget to claim another 10% left unused in the previous year. Value being 100 can be claimable here. Is that okay, sir? The additional depreciation claimable in the very first year of purchase itself. Okay, if the put to use is more than or equal to 180 days, you can claim 20% directly. If it is used less than 180 days, you can claim only 10%. Next year, you can claim another 10%. Clear? Okay, then. This is small information I explained with the illustration. 10 plus 10. Okay, if put to use less than 180 days. Provided the additional depreciation will not be available for all the assets, available only for the plant and machinery conditions. Plant and machinery, that too used in the factory manufacturing unit. Okay, not in the office, not in the office or quarters and all. That too newly purchased asset. Okay, new plant and machinery put to use within the factory, not being the administration office and quarters or residential home. Those places should not be used. Right. And this plant and machinery should not include office appliances, though the office appliances used in the factory are also not eligible. Any office appliances. Apart from that, road transport vehicle also not be eligible. Suppose if you are purchasing a forklift crane and probably bulldozers and all used within the factory, that will be eligible. Road transport vehicle not eligible. Road transport vehicle not eligible. Right. And one more condition. Condition number 1 is new. That too plant and machinery should not be used within the office or quarters and all. Can be used within the factory. And if it is being the office appliances but used within the factory, also disqualified. And road transport vehicle used within the factory also be disqualified. Not only that, sold in the first year itself, sold in the year of purchase, then not eligible. For this not eligible, for this not eligible, for this not eligible. Is that clear? C. Additional depreciation at the rate of 20% will be allowable under section 32, class 1, subclass 2A. 10% depreciation only given if put to use is less than 180 days and eligible for the remaining 10% the next year. We have completed this point. Second point being plant and machinery used in factory of manufacturing entity. It should be a manufacturer. Trader, it should not be a trader. Trader means there is no any manufacturing or factory entity available. Even printing and publishing entity is called as manufacturer. They can also claim the depreciation at the rate of 20% apart from the regular depreciation. And what about the power generating, distribution and transmission units, sir? Will they be eligible for additional depreciation? Of course, they are also eligible for the additional depreciation provided they have to add to which one? WDV method, not SLM method. If they add the SLM method, of course, they are not eligible for the additional depreciation. If WDVM depreciation is followed, only then they can claim. And conditions, no additional depreciation. When? If the plant and machinery used in India or outside India, used in India or outside India, it means second hand asset. Already it was used to some other places. Okay, we purchased from the user as a second hand product. Second hand product is not eligible for depreciation. As I already told you, it should be newly purchased asset. So, point number 1. And that plant and machinery installed in office premises or residential accommodation and guest house, not eligible. And though it may be office appliances used in the factory, will it be possible? No, sir. So, any office appliances or road transport vehicles used within the factory or outside factory doesn't matter, it will not be eligible for. And if sold in the year of acquisition, also not eligible. Okay, in the year I purchased in the previous year, sold a matter of 3 months later. It means you are cheating the government, enjoying the benefit of claiming higher depreciation and also selling and encashing your cash. So it's cheating, right? So it's not always allowed. If the asset, newly purchased asset, depreciated 100%, then also you are not eligible for claiming the depreciation. 100% depreciated. Okay. If you are claiming 100% depreciation on the asset, so in the block of assets, we have not seen anywhere 100% depreciation. Only the maximum is 40. Earlier, we had the rate of depreciation being 100% also. It was blocked now. By the time, it was very useful. If the asset was already depreciated at the rate of 100%, you cannot claim the depreciation additionally. Is that clear? Now also, you have some 100% depreciation available for some specified business. We'll study that along with section 35 AD. Okay, section 35 AD, we have a list of specified business. For them, all the assets can be claimed as depreciation. Full value the year itself. For them, the additional depreciation will not be eligible. Is that clear? So, these are the 5 conditions should be satisfied. These 5 conditions will not be eligible. If these 5 conditions not fulfilled, then you can claim the depreciation. And allowed if exercising the option of shifting out of the default tax regime. Under default tax regime under section 115 BAC, this additional depreciation is not eligible. Okay, this will be available only for the shifting out of the default tax regime, else it is not allowable. Hope now you will be able to understand the point number 3. Point number 2 and point number 3, we have completed both. To make you understand the third point, let's now start with the illustration here. Yes. Last class, we have solved this illustration, right? I may recalculate this as you learned a lot. WDV of the plant and machinery on 1/4/24, WDV being engaged in the manufacturing of PVC granules, manufacturer, value being 3,000 lakhs. So he has opted out of the 115 BAC scheme. Right. The company purchased additional plant and machinery for rupees 1600 lakhs on this date. 18/4/24. One more purchase, 1600. Inclusive of second hand machine. This 1600 includes second hand machine 400, new asset 1200. From Ireland, okay, which is 400 lakhs to increase its installed capacity of production from 1000 tons per annum to 1500 tons per annum. The production from new machine commenced on 1/12/24. The production from new machine commenced from this date. So from this date means put to use is less than 180 days only, because though purchased April itself, but we started using only from December 1st. From the December 1st onwards, year end, we have 120 days only approximately. It's not equivalent to 180 days. So eligible for half year's depreciation. Work out by giving reasons the amount of allowable depreciation. So after this 4,600, you can now claim the depreciation. As this asset is eligible for half year's depreciation, 1,600 into half year into, as rate of depreciation is not given, we assume 15% flat rate will be applicable. What's the value now? 120. Don't forget to claim the additional depreciation. Additional depreciation is calculated only on the newly purchased asset, not the second hand. For this, additional depreciation is eligible because the company is a manufacturing entity, number one, and it is also a plant and machinery. Usually nothing stated means the plant and machinery is used within the factory only. So factory is the second condition. Third condition is a new asset. So new asset, it should be a new asset, and it should be used within the factory. And third one is it should be a manufacturing entity. Only then they can claim. And then they have to opt out of the default tax regime under section 115 BAC. So under 115 BAC, you will not be eligible for the additional depreciation. So for 1,200, you can claim only 10% in this year because put to use is less than 180 days. Current year you can claim 10%. Next year you can claim another 10%. This value being 120. 240 is the overall depreciation can be claimable. So ultimate WDV being, come on, 4,000. Is it 120? Okay, we missed the balance value, right? We missed the balance value, right? So 4,600, 1,600 is subtracted, balances 3,000. For that you can claim 15% full value, 450. Now overall depreciation being 690. Yeah, closing WDV being 3,900. Okay, what happens if you add the default tax regime? In default tax regime, this one is missing. Rest of the things are same. 3,000, 1,600, 4,600, and 120, 450. 570 can be subtracted. 4,030 is the closing WDV. Is that clear? Now, let's move on to the next one. Gopi Chand Industries furnishes you the following information. We have been given two blocks. Block 1 carrying 15% plant and machinery. Block 2 building. Apart from that, transaction happened. I'll start with the block 1. Block 1 being plant and machinery. Applicable rate of depreciation for this block being 15%. Opening the WDV of that block being 5 lakhs. And this will be the block number 2. Block number 2 is all about building. And applicable rate of depreciation of that block being 10%. Opening the WDV of the block 12,50,000 rupees. How many assets we have in that block? 3. And in case of plant and machinery, how many numbers we have? 10 numbers. 10 looms we have. Acquired 5 looms. Add purchases. Okay, 5 looms for rupees 4 lakhs. Always cross verify whether it is used for more than 180 or less than 180. 5724 definitely it's more than or equal to 180 days. And sold 15 looms. So by 7/12/24 you don't have any looms, but there is no sequence based on date. We have to add all the purchases in that year. Okay, sequence means this is the day one plant and machinery you have. You purchase another 5, so 10 plus 5 15. 15 sold, then 0 blocks, 0 assets you have in the block. But we should not care about that. We have to add all the purchases in that previous year first. Then only you can go for subtracting the sales. Here one more acquisition happens on, okay, 10/1/25 for 2 looms. The value being 3 lakhs. Anyhow, this one purchased in January only. So definitely it should be eligible for half year's depreciation. So the overall value being 5 plus 4 plus 3, 12 lakhs. 12 lakhs. So originally opening LDV and purchases 5 added, so 15 blocks, 15 looms were there. On 7/12/24 all the 15 looms sold, then in the block consists 0 asset, but anything purchased in the same year will be again added further. Okay, you add in the day itself, day 1 itself, right? Minus sale in the block being 10 lakhs. 15 looms sold. Now balance, still we have 2 looms, value also we have. So value also exists, looms also exist. Then you can claim the depreciation, minus depreciation. Depreciation for newly purchased asset, okay, put to use less than half year will be eligible for half year's depreciation. So for this 3 lakhs, as put to use is less than 180 days, only half year's depreciation is eligible. So 15% into half. How much is that? 22,500. No, the entire balance itself we have 2 lakhs only. No. Okay. Then calculate for 2 lakhs only. Okay, 15,000. And what about the additional depreciation, sir? Additional depreciation also available. 2 lakhs. Okay, for the 2 lakhs at the rate of how much? 10% can be claimable only in this year. Next year and again another 10% you can claim. So the value being 20,000 rupees. Overall value being 35,000 can be subtracted from 2 lakhs. 1,65,000 will be closing WDV. Here you don't have any purchases to sale. Directly you can subtract depreciation at the rate of 10%, 1,25,000. Then closing WDV here being 11,25,000. Total depreciation claimable being, add this one and this one, 1,60,000 can be deductible under section 32 in the current year. Correct? Yeah. So we'll continue the rest in the next class.